Life insurance policies. Type of life insurance policy. Industrial life insurance issued very small face amounts such as 1,000 or 2,000. Premiums are paid weekly and collected by debit agents. They were designed for burial coverage. Group life insurance written for members of a group, such as a place of employment, association, or a union. Coverage is provided to the members of the group under one master contract. The group is underwritten as a whole and not each individual member. One of the benefits of group life coverage is usually there is no evidence of insurable required. Ordinary life is made up of several types of individual life insurance, such as temporary, term, permanent, whole. Term life gives you the greatest amount of coverage for a limited period of time. Term life insurance is only good for a limited period of time because it has a termination date. Term insurance is an inexpensive type of insurance, making it an attractive option for large political policies. Term life is the cheapest type of pure life insurance, and due to having a termination date and not having any cash value, it will always be cheaper than a whole life policy with the same face value. It produces a pure death protection, since it is only pays death benefits if insurer dies during the policy. Term is often renewable and convertible. For example, if you have a 10-year renewable convertible term, after the 10 years is up, the policy terminates, or you can renew it. If you renew it, the premium price will go up and you will have the policy for another 10 years. This continues until you are too old to renew it or it's too expensive. All term insurance has a final termination date where you can no longer renew it. If the policy is convertible, you can convert it to whole life. Think rent to own, as at any time you renew or convert any type of insurance, you do not have to worry about your health. Is your insurability is locked in. However, the price will always go up because your attendance or current age is used for the new policy. Term is typically thought of as renting. When you have a roof over your head, but there's going to be raise the price until you have a roof over your head, but they're going to raise the price until it no longer makes sense for you to keep it, or at some point terminate the contract and kick you out. Low term or level term, also called level premium. Level term has a level face amount and level premiums. Premiums tend to be higher than annual renewable terms because they are level throughout the policy period. However, the premium will increase at each renewal. Life insurance written to cover a need for a specific period of time at the lowest premium is called level term insurance. Term insurance always expires at the end of the policy. For example, if D needs life insurance that provides coverage for the remainder of her working years and wants to pay little as possible, D would need level term. Level term provides a fixed low premium in exchange for coverage which lasts a specific time period. Decreasing term. Term life insurance that provides an annual decreasing face amount over time with level premiums. These policies are used for mortgage protection. A decreasing term policy is a type of life policy which has a death benefit that adjusts periodically according to a schedule and is written for a specific period of times. Decreasing term policies are usually written for a mortgage or other debt that typically decreases over time until it's paid off. For example, 15 years. Decreasing term policy could protect a 15-year mortgage as a mortgage balance reduces each year. The face value of the insurance will adjust according to match. After the mortgage is paid off, the insurance will expire. Credit policies are typically purchasing using a decreasing term life insurance where with the term matching the length of the loan period and decreasing insurance amount matching to the declining loan balance. Since credit life insurance is designated to cover life as a debitor and pay the amount due on a loan, if the debitor dies before the loan is repaid, credit policies can only be purchased for up to the amount of the debt or loan outstanding. For example, if you want insurance policy to protect a $20,000 5-year auto loan, you would use a 5-year decreasing term life insurance policy for an initial face value of $20,000. You would pay the same level premium every month for 5 years term of the policy. The face value would start out at $20,000 and change according to schedule, decreasing balance of the auto loan. After 5 years, the car will be paid for and the insurance policy no longer needed. Increasing term life insurance that provides an increasing face amount over time based on specific amounts or a percentage of the original face value. Convertible term. A term life policy has provided that allows the policy owner to convert their term insurance into permanent policy without showing proof of insurance. Convertible term provides temporary coverage that may be changed to permanent coverage without evidence of insurability. For example, if you take out a term insurance policy when you are young to take advantage of your good health and the policy's low premium, but you want an option to convert the policy to permanent one for final expense and benefits. Once your finances improve, you would want a convertible term policy. The conversion privilege of group term life policy allows an individual to leave the group term temporarily plan and convert his or her insurance to an individual permanent policy without providing evidence of insurability. The most important factor to consider when determining whether to convert term insurance at the insured attendant age or the insured original age is the premium cost. The number one factor which implies life insurance premiums cost is the insured current or attendant age. For example, a $25,000 policy on a healthy 7-year-old boy will cost substantially less than a $25,000 policy on a 57-year-old man. Whether converting an individual or group term insurance, although your insurability is guaranteed at your age, it's typically reviewed to your current attending age, not at the age you were when you applied for the original policy. Convertible term would only allow you to take your temporary coverage and change it to permanent coverage without evidence of insurability or good health, but your premiums will increase due to using your retiring age. Renewable term insurance that guarantees the insurance right to continue term coverage after experience of the internal policy without having to provide insurability. Renewable term provides temporary level coverage at lowest possible cost for a limited period of time, but then allows the policy owner to renew the policy to maintain coverage past the policy's termination. When a term policy is renewed, the insured does not have to prove insurability. However, the premium price will raise because the insurance company will use the insured current or attendant age to determine the new premium. If a customer wants coverage at the lowest possible cost, that would be good for a limited period of time, but offers the ability to continue with the coverage after the expiration, the customer would want a renewed term policy. Annuities, renewable term coverage that provides level face value amount that renews annually. This type of coverage is guaranteed renewable annually without proof of insurance. A term rider is a type of life insurance which covers children under their parents' policy. Family plan policies usually cover the family head with permanent insurance, and the coverage on the spouse and the children is term insurance form of a rider. A term rider is always level term. This is cheap, and then even every family member gets their own policy. For example, the main policy may be on the dad, the mom, and the children are riding on attaching to the dad's policy as term riders. Term riders allow for additional family members to be covered under one policy by attaching everyone to a main policy. Term riders can also allow an applicant to have excessive coverage by adding an additional term rider for them to the main policy. Whole life insurance that provides death benefits for the entire life of the insured. It also provides living benefits in the form of cash value. It matures at age 100 and normally has a level premium. Whole life insurance provides both living and death benefits, providing premium life insurance protection for the insured entire life. It also provides living benefits such as cash value and policy loans. Advantage of whole life: covers the entire life of the insured, living benefits, cash value, and policy loans, fixed premiums. Drawback of whole life: protection is more expensive because of living benefits. Premiums paying period may extend beyond the income earning years. Whole life often compared to buying a house. You can pay the house off slowly or quickly, but once it's paid for, you still own the house. There are several types of whole life. All whole life has the same type of benefits. The only difference in the types of whole life is how the policy is paid. Some will be paid straight until death or age 100. Some will be paid after a few years or by a specific age. Some may give you a little discount in the early years to help you get started. All whole life lasts until death or age 100, has a fixed premium and level benefits with cash value accumulation, regardless of how it is paid. Typically, whole life insurance includes straight whole life, limited payout whole life, single premium whole life, modified whole life, graded whole life. Straight whole life. This is the basic whole life insurance policy. Life insurance with a level face amount and fixed premiums payable over the insured entire life. Premium payouts made until death of insured or age 100. Maturity of policy.